Welcome back to Origins. This is our Minisode. This is the podcast that dives deep into the business of venture capital, where we learn how the people behind the capital, both GPs and LPs, make decisions. I'm Nick Chirls, GP at Asylum Ventures.
And I'm Beezer Clarkson, your LP co-host from Sapphire Partners, where we aim to invest in exceptional early-stage venture capital managers, ranging from emerging to established franchise VCs. And I am so excited, Nick, to talk to you about our recent conversation with your friend Kyle.
Me too. Turns out you guys are like not even neighbors, but like literally across the street.
Yeah, so the Sapphire office in Austin is part of this complex. And I don't think he's in the complex, but I think if I threw a stone, I would hit his apartment building, which is embarrassing because we've been here for, I don't want to say how many years.
You guys are busy people. I'm a Bitcoin person.
I know. I can't wait to hear this. I know you're more Bitcoin than he is.
I think the criticism of Bitcoin as an unproductive asset is fair. I also think there's something about historical brand value being anointed as the sort of the asset. I think in many cases, Bitcoin's reluctance to change and evolve is a feature, not a bug. The scarcity of Bitcoin is more feature than bug. I think all the sort of institutional infrastructure now built around it is compelling. If I were to hold one asset for the next 20, 30, 40 years, it would still be Bitcoin.
Ooh, I love it.
But maybe I'm like crypto boomer at this point. I haven't updated my thinking. So that was one piece. And then what I do agree, which I'm deeply disappointed in, is disappointment around sort of Web3 as a concept. Mm-hmm. I do think that's where some of the like rich innovation could have occurred. Mm-hmm. I do think ultimately without the sort of Web3 opportunity, which I would maybe just describe as like decentralized internet, new internet, I do think the market opportunity for crypto is net smaller. That's actually what I got most excited about. Maybe didn't invest as aggressively, but I think just philosophically got really excited about in terms of data sovereignty, privacy, personal ownership of your data and life. I think the reality is like the general population doesn't give a shit. Like privacy and data ownership at the end of the day are not compelling enough propositions for the general population to enable a critical mass for sort of Web3.
Is it possible it's just going to get embedded?
No, I don't think so. I don't think for Web3 applications.
No, but
I think
more
for finance.
For finance,
for sure.
And then
yeah. But I at the end of the day, I don't think people care or want a decentralized Uber.
Oh no, I meant more. Do you think people will use blockchain or the appropriate other technology in the crypto world to create the kind of data privacy that I don't even know I need? But
no, I don't think people care
behind things.
I don't think people care, okay. And I think for applications like Uber or Airbnb or TikTok, like traditional databases work fine. Oh. And people don't care about privacy. Okay, one question for you. Mm-hmm. LP hat on. You've now underwritten a bunch of crypto managers. Or maybe not a bunch, but a few. Yeah, what do you look for? And how does that maybe map with some of our conversation around with Kyle?
I think the similarity between all of our fund managers is looking for people that have a strong point of view, think for themselves. And I'm trying not to say first principles, but it's very similar, right? I know you always use you as an example. Like you're looking at what you think is going to be true or the questions you have and where you're investing. And we have a similar take on our crypto managers versus our venture. Like there needs to be a reason why they're doing what they're doing. And if it's purely momentum, then they have to be smart at momentum. But usually it's something more like Kyle, where there's a belief. Mm-hmm. And it's not always very specific in finance, but there has to be some sort of understanding. Mm-hmm. We do same thing, track record, blah, 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 all those things. What I thought was intriguing about what he said was the buying and not selling. Because I would say one of the things that we've seen amongst our crypto managers is because, and again, this is shout out to you, and you're the first person who pointed out to me the 4-year bull bear curves in crypto. And one of the things I keep listening for, once you point this out to me, is how many of the other crypto managers see what you saw. and then are smart at playing where they are in the market, and people can play it differently. But having that understanding is, to me, a very critical filter.
Mm-hmm.
And we've had a number of managers who have done that smartly to return money.
Mm-hmm.
And I think it was not appropriate for this pod, but I would love to have dug into Kyle with, well, how does that work for his LPs? And there are some LPs just shouting out that care about TVPI and IRR more than DPI. So maybe it works just great for them because who knows, maybe he's got awesome TVPI even if he's not selling. And then you do the hedge fund if you then want to get your cash out because you can redeem. So we do ask our crypto managers, because of the liquid component, how they think and what they do, and then underwrite based on some of those attributes as well, which is different, to his point, than venture funds, because you can't create a market in a private illiquid asset. I mean, there's secondaries, we've talked about that, but it's just not the same thing as a liquid asset.
Yeah. My understanding is that they have returned a very, very, very meaningful amount of capital to their LPs, even though they don't sell that often, as in through distributions and other methods.
Yeah, his reputation precedes him, so my suspicion is people have done just fine.
And by the way, he is 100% correct in that a lot of folks talk about sort of when they got into crypto or when they bought, their first. The hard part was not buying Bitcoin in 2012 or 2013 or whatever. That was not the hard part. That was the easy part. The really hard part was holding it for the last 12 years.
Oh yeah, good point. That's an excellent point.
That was the really hard part. Through all of the cycles, regulatory issues, hard forks, security concerns, even within the Bitcoin community, like political disagreements, like the hard part was putting that aside and forgetting about all that and holding it through insane volatility. He is right in that because of the crazy volatility and all the other issues around crypto, the easy part is going and buying some.
Mm-hmm.
The hard part is having a view on how long to hold it, why you're holding it or selling it. That's the really hard part. There are a lot of people that bought Bitcoin a long time ago and sold it a long time ago. In fact, it's you have to be sort of insane not to do that, right? Like you're looking, anybody that's sitting on a 10x, 50x, 100x, 200x, like
yeah,
that is the hard part.
You've been my guide through a lot of crypto, as everyone can hear, so I keep referencing back to you. But I remember talking to you about thinking, because the selling motion is really different understanding. It's much more like a public stock trader or a long short, mostly long.
And distracting.
And
looking
distracting.
At the prices is super distracting.
Which is not a typical venture. You don't get trained in that, your typical venture fund. You get trained in thinking through other ways of exiting. And I would argue not enough discussion goes on about exiting full stop in venture landscape. But you don't have to make the same kind of long hold things for 15 years. It's just wild with a liquid asset that is going through this kind of technology revolution at the same time. Wildly different.
I continue to believe, I think I've written about this as well somewhere, but I continue to believe that folks that have been trained in crypto investing and trading are going to be by far the best investors and traders in traditional markets, because they've learned to stomach insane volatility, insane cycles. And so when you go to traditional markets and there's, ups and downs of a few percentage points each day, you're like, whatever. You can really stomach, I think, really crazy volatility, which I actually think is relevant for early stage venture too. You're not looking at the stock price every day, but if early stage startups were trading, insane volatility. And so like, I think there's really important learning and education in participating in crypto markets, and it's applicable for other markets. So, yeah. Cool.
Thank you again for bringing Kyle on. I love it.
Yeah, so much fun. Excited for our next episode with Micah from Founder Collective. We'll see you soon.
I'll see you soon.
Thanks for listening to this Minisode of Origins, the show where we discuss the venture capital ecosystem through the lens of myself, a GP, and my co-host Beezer, an LP.
We'll be back soon with a new episode of Origins. You can find that right here in this feed, and while you're there, please rate and review the podcast. It's truly super helpful for other folks looking for venture insights to find our show, and really, really helpful for Nick and I to know what you want to hear. I'm Beezer Clarkson.
And I'm Nick Chirls, and we'll be back soon. Thanks for listening.